Today, more ups and downs, a market update for the 5th of February 2022. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering funds and property news with a distinctively Australian flavour. The S&P 500 turned positive on Friday, aided by a rally in Amazon and an unexpectedly strong monthly jobs report that sent US Treasury yields to two-year highs. The S&P 500 rose 0.52% to 4,500. The Dow Jones Industrial Average slid 0.06% to 35,089, while the NASDAQ rallied 1.58% to 14,098. The US economy created 467,000 jobs last month. That was well above the expectation for 150,000, and it was led by job gains in the leisure and hospitality sector, which confounded expectations that an Omicron impact would weigh on the services industry. The jobs data today was incredibly strong, even before the stellar revisions, so the Fed has the green light to start moving off zero very soon, said Jamie Cox, managing partner for Harris Financial Group. The report suggests demand for labour remains robust and further reinforces Fed Chairman Jerome Powell's description last month of the labour market as strong. Average hourly earnings increased by a better-than-expected 0.7% for the month, while the unemployment rate ticked higher to 4%. An unexpectedly strong number isn't likely to change the Fed's thinking on policy, but may serve to drown out the policy mistake narrative in the market that bubbled up as the Fed turned more hawkish in recent months, Jeffries said in a note. US yields surged on expectations for more aggressive Fed action, with the 10-year US yield jumping 4.85% to 1.916 for the first time in 2 years. The 2-year yield rose to 1.316, and the 5-year yield reached 1.78. Tech climbed out of early-day trouble against the backdrop of raising rates. A surge in Amazon restored sentiment on growth somewhat after Meta's plunge a day earlier. Amazon rallied more than 13% following better-than-expected fourth-quarter earnings and fiscal first-quarter guidance. It landed at 3,152. The bulk of earnings beat was led by gains from the company's Rivian stock, but better than feared quarter one guidance and the move to hike the annual price of US Prime subscriptions to offset costs also helped boost investor sentiment. Amazon's profitability should expand as it grows OPEX more slowly than revenues, and Amazon's web services, fulfillment by Amazon and ads should drive steady margin expansion, with Prime memberships driving overall retail revenue growth, according to Wedbush. Other mega-cap stocks, including Alphabet, Meta Platforms, and Apple, were all off their session lows, and that underpinned the move higher in the broader market. Snap, meanwhile, jumped more than 58% following quarterly results that topped expectations. It ended at $38.75. The wild swings in markets recently, however, is expected to continue and likely sets up a rocky road for the weeks ahead until there is more certainty about the path of inflation and the Fed's plan to tighten monetary policy. Volatility generally means bear markets, and the fact that we've seen a spike in volatility doesn't bode well for overall markets, said Darren Schringer, CEO of Asymmetric ETFs. Volatility is set to continue until some of these other factors, primarily the Fed and inflation, settle down. The VIX, though, was down 4.64% to 23.22. Portfolio positioning would be best served by companies that are actually able to pass on price increases to preserve their margins and are growing the top line. Former US Treasury Secretary Lawrence Summers told Bloomberg that investors need to brace for the Federal Reserve to potentially raise interest rates at all 7 remaining policy meetings this year, and even for it to hike by more than 1/4 of a point in one go. Markets have to be prepared for a rate hike in every meeting, and they have to be prepared for the possibility that, as the inflation process continues, we might need to have meetings with more than a single 25 basis point rate hike, he said. The Fed is behind the curve, and anyone not open to considering that policymakers will boost rates at consecutive meetings throughout the year is underestimating the range of possibilities, said Summers, a Harvard University professor and, by the way, a paid contributor to Bloomberg. Now, in commodities markets, oil extended its rally while gold was steady. The unhinged oil rally had everything going for it, from geopolitics to supply politics. The only thing missing was a real weather crisis. That was made up for this week by the Texas freeze that tipped the market firmly above $90 US on fears the Permian shale basin could get frozen again like last year. US crude and its UK peer Brent rallied for a seventh straight week, racing towards Wall Street Bank's call of $100 a barrel. To be sure, that target was made well before the Russian-Ukraine crisis, half-hearted production hikes by OPEC+, and now the Arctic blast gripping much of America, including Texas. That's the fourth hottest US state outside of winter, by the way. Crude prices seem to have a one-way ticket to $100. Ed Moyer, analyst at online trading platform Onya, wrote in his weekly commentary. This week's rally in crude oil was supported by the OPEC+ decision to stick to their gradual increase strategy, and as US production fell again, an Arctic blast is also disrupting some production in Texas, and that is driving this latest price surge. Everything seems to be turning very bullish for WTI crude, and the bullish momentum might not see much resistance until the $95 level. New York West Texas Intermediate was up 1.86% to $91.95 per barrel, and this year alone WTI has gone up 23%. The rally in oil gained a new impetus as the focus fell this week on Texas, where temperatures were forecast to dip below 20 degrees Fahrenheit, that's -7 Celsius, in many parts of the coming days. West of Texas is home to the Permian oil and gas basin, which spills over into New Mexico's southeast. The relative strength of the cold in mid-Texas cannot be understated. Consecutive days of freezing temperatures within this week have the potential to lead to additional freeze-offs in the Permian, said Dan Myers, analyst at Houston-based energy consultancy Gelber and Associates. The stakes of another super freeze are high in Texas, where last year's winter storm led to blackouts and deaths of more than 200 people. And as Bloomberg noted, this year's storm will test whether Texas Governor Greg Abbott and Republican lawmakers have done enough to bolster the power network, including new rules requiring the grid operator to increase reserve capacity and to make it easier for industrial users to get paid to reduce consumption. Texas officials have said that they are confident that the Lone Star State's power grid can avoid a repeat of last year's catastrophic blackouts as a major storm sweeps through the region, although the icy blast could still bring local outages. Now, gold futures finished higher on Friday, tallying a gain of more than 1% for the week. Prices had briefly fallen below the key $1,800 mark during the session, after data showing a bigger than expected monthly rise in US jobs. The surprisingly strong non-farm payroll report sent expectations soaring that the Federal Reserve's near-term tightening will be much more aggressive, said Ed Moyer. Gold was up 0.27% to 1,808. London's FTSE ended the week in positive territory after 2 weeks of losses, despite edging lower on Friday as banks retreated a day after the Bank of England raised interest rates to curb soaring inflation. The FTSE 100 closed 0.17% lower, reversing earlier gains and leaving it up 0.6% higher over the week at 7,516. And meanwhile, the mid-cap index declined 1.2%, but still recorded its first weekly gain after a 4-week losing streak, advancing 0.5%. Energy stocks outperformed, rising 3.8% to their highest level in nearly 2 years, as oil prices extended gains on US supply concerns amid frigid US weather and ongoing political turmoil. Base metal miners ended the day flat, while banks dropped 1.2% after rallying as much as 2.4% this week. If you've got a rising interest rate into an economy that is weakening, consumer sentiment crashing, and many other factors that domestic UK banks are facing right now, that can push traders to sell off a little bit after a week's rally, said Keith Temperton, a sales trader at Forte Securities. The Bank of England raised interest rates to 0.5% on Thursday, and nearly half of its policymakers wanted a bigger increase to contain rampant price pressures, as the central bank warned inflation will soon be above 7%. Two-year yields on British bonds rose to their highest since April 2011, while the five-year yield touched a level last seen in October 2018. Shares in SSP rose 0.7% as the upper crust owner said its sales were recovering after a slowdown in recent weeks when fewer people travelled due to the Omicron-led curbs hitting its stores at train stations and airports. Now, over in Europe, markets were mixed, with rising bond yields weighing on the German market, in particular, following the European Central Bank's hawkish turn on Thursday. The DAX in Germany traded lower, down 1.75% to 15,099. The European Central Bank decided to keep interest rates unchanged at its policy-setting meeting on Thursday, as widely expected, but the ECB President Christine Lagarde declined to repeat previous guidance that an interest rate increase this year was extremely unlikely, leaving the door open to a 2022 hike. The ECB has been seen as among the most dovish of the world's leading central banks, but this change in stance has seen German bond yields rise on Friday, with the 5-year note trading above zero for the first time in over 3 years. An influential investment bank, Goldman Sachs, now predicts 2 interest rate hikes this year in September and December. This has tended to overshadow a larger than expected rise in German industrial orders in December, up 2.8% on the month after a revised increase of 3.6% in November. Numbers that suggest the German economy's contraction at the end of last year won't be extended into 2022. But the Eurozone retail sales did show the impact of the Omicron surge late last year. Carlsberg stock rose 2.2% after the Danish brewer posted fourth quarter sales above expectations, while Sanofi rose 0.5% after the French drug maker posted a hefty rise in its 2021 earnings and predicted even stronger earnings next year after losing ground in the COVID-19 vaccine race. Assa Abloy soared 6.3% after the world's biggest lock maker reported better than expected fourth quarter profit growth on Friday, as stronger demand helped mitigate continued pandemic-related supply chain challenges, and Intesa Sanpaolo pulled back from its highest in nearly 4 years after Italy's biggest bank by assets announced plans to hand back to investors more than €22 billion in dividends and a share buyback over the period to 2025. Other bank stocks, however, were in the ascendant as the ECB's message lifted bond yields, offering more attractive lending spreads for their key businesses. Deutsche Bank, Societe Generale, National Bank of Greece, Unicredit, and Banco de Sabadell all hit their highest in over a year. Asia-Pacific stocks were mixed on Friday, with Japan's Nikkei 225 edging up 0.73% to 27,439, while Chinese markets remain closed for the Lunar New Year holidays. But Hong Kong's Hang Seng jumped 3.24%, 24,573. And Drewry's Composite World Container Index decreased 2.9% to 9,419 per 40-foot container this week, but still remains 79% higher than a year ago. The Australian stock market ended a 3-week losing streak on Friday, with local shares closing higher as they shrugged off savage midweek selling on Wall Street. The S&P ASX 200 rose 132 points, or 1.9%, to 7,120 this week, supported by a 42-point, or 0.6% gain on Friday. After dipping slightly on Friday, the local share market began to rally on Tuesday, supported by a cautious tone from the Reserve Bank of Australia that bolstered investor sentiment. Markets were helped by a rally from oversold conditions, mostly good US earnings results, and as Fed officials downplayed expectations for a 0.5% rate increase in March, said Shane Oliver, AMP Capital's head of investment strategy. Australian shares benefited through the week from the positive global lead and the indications from the RBA that it would be patient in raising interest rates, with energy, utility, retail and property stocks leading the rally. Westpac led the market gains, rising 4.3% to 21.52 after reporting cash earnings, excluding notable items, up 1% to $1.58 billion in the 3 months ended December 31. The result beat market expectations, driven by stronger revenue and faster cost-cutting, although the margins are still under pressure. The results of the other major banks were mixed. Commonwealth Bank fell 1.6% to $94.10. ANZ slid 1.4% to $27.09, while NAB rose 0.9% to $27.91. A number of other financial stocks fared better. Macquarie Group firmed 2.9% to $192.34, and QBE Insurance advanced 10% to $12.22. The energy sector also supported the gains as crude prices hit multi-year highs. Woodside Petroleum climbed 5.8% to $26.27. Sanders rose 6% to $7.45. Origin Energy firmed 6.7% to $5.90, and Beach Energy advanced 4.9% to $1.50. Fortescue Metal Group was also among the market leaders, rising 9.7% to $21.34. But News Corp climbed 11.7% to $33.38 after reporting its highest earnings since its 2013 separation from 21st Century Fox. The group's EBITDA rose 18% to $586 million in the 3 months ended December 31. New Farm ended the week 26% higher at $5.52. Its December quarter revenue rose 36%, putting it on track to deliver improved revenue and earnings growth for the year ended June 30. The result was driven by favourable weather conditions and strong customer demand in all regions, they said. Boral shares tumbled 36.1% to $3.80. On Tuesday, the company outlined details of its $3 billion return of capital to shareholders. It traded ex-dividend on Friday, however, with the value of the cash returned being largely wiped from the company's share price. Ansell shares also tumbled after the company announced a hefty 27% profit downgrade for the financial year ended June 30th. The company's share price closed the week 16.8% lower at $25.98. And by most measures, the Australian economy is rocketing out of the COVID-19 pandemic and doesn't look likely to slow anytime soon. Indeed, on its current rate, the economy will grow larger later this year than it was forecast to be in February 2020. Unemployment at 4.2% in December was well ahead of official forecasts and is now expected to fall below 4% later this year for the first time since 1974. If things continue as they are, there's a chance the rate could even fall to 3% in a couple of years' time, according to the RBA's quarterly economic outlook released on Friday. Prime Minister Scott Morrison may not be much interested in leaving a legacy, but the lowest unemployment in half a century will be just that. But while the economic data has presently surprised over the past year, there is one figure that remains sluggish, and that's wages growth. According to the RBA, it will hit 2.5% by June this year, before edging up to 3% 1 year later. From a political perspective, this is not an ideal outcome for the Morrison government heading into an election campaign. Wages now forecast to grow slower than headline inflation for the whole of 2022, giving Labour a powerful campaign message on the cost of living. Of course, that's only the case if the forecasts come to pass. Some economists view the bank's most recent forecast for the economy, including wages, as being too conservative. After all, this week the bank has been forced to bring forward its expectations for when rate rises will begin by a full year, with liftoff this year now a plausible scenario, after being very unlikely just 3 months ago. Despite headline inflation coming in much stronger than expected over the past 6 months, the RBA is forecasting it to hit 3.75% in June. Given the consumer price index is running at 3.5% in the December quarter, that, to many, seems optimistic. But it's the RBA's forecast for wages growth that has piqued the interest of bank watchers. The RBA wants to see annual wages growth at 3% or more as an indication inflation will be sustainably within its target band. It doesn't, though, expect that to happen until June next year. But with 85% of businesses reporting a lack of staff holding back their operations and record high vacancy rates coinciding with a 13-year low unemployment rate, well on its way to a 50-year low, the pressure is on. Lowe is sceptical, even with the current level of labour scarcity, that wages will pick up quickly. He doesn't think there will be an outbreak of higher wages and higher inflation. He may, of course, end up being right, but there are plenty who don't think so. And with the RBA now forecasting unemployment could fall to a once-in-a-generation level, the risks continue to grow. And elsewhere, Bitcoin rose to intraday highs of 40,600 US for the first time since January 21st, in a shift from the bearish mood. At the time of publication, Bitcoin was trading at around 40,595. That's up 10% in the last 24 hours. Bitcoin has managed to stage a sharp recovery after dipping earlier due to unexpectedly strong US jobs data. And Ethereum is also up 12.63%, closer to the $3,000 level. The market seems to have received a bullish push when Marathon Digital Holdings, a Bitcoin mining company in North America, said on Friday that it increased its holdings of the cryptocurrency to around 8,595 Bitcoins, or around $338 million. The majority of altcoins have managed to recoup nearly all the losses of the past 7 days and were up since the past week. On-chain analytics Sentiment notes the outstanding performance of selected altcoins over the past 7 days. Despite Bitcoin staying flat over the past week, many altcoins have quickly crept back an inch toward their pre-slide prices. And Lex Mazowski, a crypto trader, also noted that Bitcoin shorts liquidations have started to roll in. According to CoinGlass, in the last 4 hours, short liquidations for Bitcoin had reached $123.37 million. Some analysts flagged the possibility of a short squeeze as a catalyst for the recent Bitcoin price increase. Jason Dean at Quantum Economics said that Bitcoin's recent moves do seem to have coincided with the latest US job reports, and this may have simply acted as a catalyst for an overdue market move. Standing back, more broadly, volatility across global markets have been the name of the game in 2022 to date, with central banks tightening monetary policy just as the economic recovery from COVID-19 shows signs of slowing down. In the first half of 2022, we are now experiencing a rates shock. Brandywine Global Investment Management portfolio manager Tracy Chen told Bloomberg, if the US Federal Reserve, Bank of England and other central banks are so aggressive in hiking interest rates, potentially we're going to face a recession risk in the second half, or at least a slowdown in the economy. Investors may be set for the next so-called pain trade, with market participants increasingly coalescing around expectations that the Federal Reserve will need to act aggressively to combat persistent US inflation. As traders brace for a series of interest rate increases this year, starting in March, many could be caught flat-footed in crowded bets that are designed to profit from anticipated monetary policy moves should market-based expectations suddenly shift. The next pain trade could come if inflation moderates more quickly than expected and rates come off quickly, with the 10-year yield falling back down to 1.5%, hurting those who have positioned for aggressive rate hikes. Or it could come from inflation staying durable and the unwinding of risk. Or potentially, rate rises could reverse lending growth, force markets lower, and that could lead to deflation. Who knows? And that really is the point. We are still in this period of great uncertainty at the moment, and really, I don't think anybody quite knows how this is yet going to play out. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.